Well, hello, this is Josh Thomas at Community Lending Group coming at you on a Sunday night, probably the first time in my career that something like this has happened that I remember anyway, since 2003. So it seems like it's kind of urgent. Seems like a lot of people are going to have a lot of questions. And so in an effort to answer some of those questions beforehand and to give you guys some of the information, as if the coronavirus hadn't already given us enough to think about over the last little while, we now have this Federal Reserve rate cut. And so I'm going to kind of break this down a little bit. So number one, I've already gotten several people reaching out to me and asking me that the Fed's cut their rates to zero. Does that mean that mortgage interest rates are zero? And the short answer is no, most definitely not. The Fed funds rate, which is the premise of the prime rate. Sorry, I got to get all the names straight in my head here. Anyway, that prime rate is definitely going to be impacted. It drops by that 1%. However, that's, by the way, on the heels of a 0.5% cut just, a week and a half ago or 2 weeks ago, or I don't even remember when they did it now. Time's blending together. But in any case, the Feds did cut their rates. Will that have an impact on our mortgage interest rates? And the answer is most likely not. However, they did additional stuff. They did quite a few different things. They also announced a $700 billion quantitative easing. What that means is that they're going to be purchasing both mortgage-backed securities and treasuries. When they purchase those are bonds. That will have a direct impact on our interest rate market. I'm going to come back to that in a little bit more, but $700 billion of purchases of both those markets. Probably the bigger reason why they're making that announcement is because in the last week there's been a liquidity crunch. Banks, as they balance out at the end of the day, each day they typically have, some of them will have reserves or surplus, some of them will have a shortage, and they'll balance out, and all is well as long as they can all balance out. But when all the banks tend to go short, particularly from bank runs or other things like that, then they have to go to the Federal Reserve. Well, anyway, there's been a liquidity crunch, and one of the things the Fed came out to just a few days ago and said is that they're going to be supporting that liquidity market, or what's called the repo market. But today they announced that they were actually going to be purchasing this $700 billion, and that's going to have also a direct impact on that liquidity. And so they're just basically trying to tell everybody across the whole globe that they're committed to liquidity and that there's not going to be a problem. But because they did announce that they're going to start buying $40 billion in mortgage-backed securities starting tomorrow, that's something they used to do all the way up until the end of 2017. They were purchasing $35-40 billion of mortgage-backed securities every day, and then they started ramping that down with time in 2017 and 18. And that's part of what it set interest rates up in 2018. But anyway, when they purchase $40 billion tomorrow, you better believe the mortgage-backed securities will open up higher, which is good, and it'll definitely continue to strengthen it. They have another 5 times they're going to do that same thing over the next weeks, months, I don't know. In any case, with them doing that, it'll definitely improve the mortgage-backed security market, which does typically directly impact our interest rates. However, and this is the thing I was going to actually finish with today, but we're at capacity. The mortgage industry as a whole typically does right around $3 trillion of mortgages in a full year. There are $11 trillion of mortgages in the United States of America, and because interest rates just came down like they did, about half of the country is eligible for refinance. So over $5 trillion of mortgage holders are eligible for a refinance right now. And if we can only handle $3 trillion in a year with any normal capacity, what would you think is going to happen when 5 or more trillion tries to come through immediately? And so I'm not so sure that we're going to have a good experience over here over the next few weeks and months as everybody tries to do this. Already starting 2 weeks ago or about a week ago, we hit a very backed up position. All of our appraisers, our title companies, me, everybody I work with is just busy. Here I am on a Sunday night of all times to be adding to an already past full-time week, And so when you hit that kind of thing, people start to burn out and things like that. And anyway, so the company, so if anybody's needing a job, incidentally, it's probably a good time to check with mortgage companies, because we're probably going to be hiring. But just kind of keep that in mind as you ask the questions, what will interest rates do and stuff like that. Most of the quotes I've been given to people that are trying to do something like if they're already at a 3.75 or lower, most of them have not been impressed with the options that we've been giving them, even if the rates are 3.25%, 3%, even 2.75. I have had a few people take advantage of that, particularly if they're trying to take money out of their mortgages. But as of this weekend, when I was quoting some people some interest rates, almost all of them were in the fours. And then, and that's for great credit, okay credit, just kind of everything in the middle, without buy down points. And if they actually paid some buy down points, which, 1%, 2%, or even 3% to buy down their rate, well, then they were getting into the threes, maybe into the twos, but the twos typically took 4 or even 5% to get there. So I'm not expecting this to be a great refinance opportunity, even with the mortgages, the mortgage-backed securities being bought by the Feds starting tomorrow. The main reason being is because if lenders are already at capacity, and a part of the reason that they're at capacity is simply, or not capacity, part of the reason that the rates are a little higher is simply because they're at capacity. So if they're already at capacity and rates go even lower, are they likely to lower their rates? Because the mortgage market might be better, but if the mortgage market's better and they're already super busy, why would they actually lower their rates and make themselves busier? And so a lot of them will take advantage of it by increasing their margin, their profits. Some of them, there's other issues too that are coming into it. And so anyway, long story short, I don't actually expect that we're going to see a great, betterment of the rates tomorrow or anytime shortly. But we'll see. We'll keep an eye on it. I guess just one other thing I just wanted to add to this, just about COVID-19 and the impact on the economy and all that stuff. It's serious. I mean, it's 170,000 people infected now in the world, and 6,000 plus that are already that have died. Something like 70,000 have recovered. Incidentally, even here in Utah, I think we have 28 cases as of today, and one of them from Twill, he's already recovered. He's already two tests negative already. I think panic is actually probably the biggest threat to our economy and everything else right now. But in an effort to help everybody relax just a little bit that can hear this video, the panic. So first off, a year ago, before COVID-19 became a thing that we were aware of anyway, the economy was already showing indicators of a recession. Now, people often don't even understand what a recession is. A recession simply means, let's just say somebody makes $100,000 in a year, and then the next year they make $90,000. That's their income for the year. Well, that means that their income receded, and that's all an economic recession really is just the U.S. economy and all the value of it, and all the money that's being spent by the consumers and businesses as a whole. If it shrinks a tiny little bit, even at 0.1%, well, that's considered a recession. Recessions typically will influence behavior more than they'll influence other things. For example, when we're in a growing bullish market like we've been in for the last 13 years or 15, is it 13? Something like that. When we're in that kind of market, then employers oftentimes will add to their employers, the employees. They'll constantly hire more and more and more. But then one of the indicators that we're heading towards a recession is that the employers stop hiring more people and then just work their people more, cause them to work overtime and stuff. And then what they'll do is they'll start to retract the hours altogether, just slowing production down or whatever. And then the employees eventually reach a point where they're just working 40 hours. So the employer went from hiring more to not hiring more, but making everybody work overtime, to not even making them work overtime and just working normal. And that's kind of the normal ebb and flow of an economic cycle. And that's been going on already. We've already been seeing that for the last several months. Other economic indicators are when the short-term rates become high, when the long-term rates go under the short-term rates. It's called an inverted yield curve, and that's something we've been looking at for probably the better part of 9 months now. And anyway, all kinds of indicators have already been pointing at a recession. It's not the end of the world. It's just the opposite end of the cycle of what we've been in. We kind of all feel like we need it. I think it's been one heck of a great money run for a lot of people for a while. Well, it's time to kind of button down the hatch a little bit and clean up and get out of debt and a couple things like that while we wait for the next bull run, I guess. So we will hit a recession because of this, but it's something that we kind of already expected to be coming. Maybe not as a cause of an illness, but just, we've been here before. We'll get out of it again. More than likely, housing will be what pulls us out of a recession in this case, because housing is still very, very strong in that there's still a lot of demand to move into a house. Back in the day, the last crash that we had, it was people investing in homes. There's a few investments going on now, but the lion's share is still people trying to own or occupy a residence. As long as that's the case, housing will probably, it should likely remain strong. Yes, people will lose their jobs. Yes, they'll come out of the housing market. And yes, that'll temper the housing market, but I just don't believe that it's going to have a big enough impact to actually put us into a recessive housing market. So anyway, hopefully some of this is insightful and helpful. It's a Sunday night. I haven't really thought about this for a while already for the weekend, but hopefully this all makes sense and is insightful to you guys. Just biggest takeaway for you guys, number one, don't panic, just relax, make smart decisions. And if things go bad at your job or something like that, maybe it's a good opportunity for you to make a career change or a company change or something like that. Just remember, a lot of people are making a lot more money right now, mortgage companies included, Charmin probably as well. But just, maybe look around, look for new opportunities, pay attention to where there are needs, because where there are needs, there's opportunities, right? And so look for those opportunities. Changes like this oftentimes can make us better. And then second biggest takeaway is, if you're looking for a refinance, if you're looking to get a better opportunity on your interest rate, don't be overly surprised if there's a disconnect between real interest rates from lenders and the mortgage market itself, just because of sheer capacity. So stay tuned. We'll do everything we can. I do not think it's worth panicking. I do think interest rates are now going to be as low as possible for an extended time. So just take your time, meet with me, let's talk, and let's get y'all taken care of, okay? Have a great night.